Hi, and welcome back to Stop Being Sold. I'm Michelle, and I'm here with Brian. And today we're discussing today's Fed announcement that they're raising rates 50 basis points or half of 1%. And what this means for you, your family, and your wallet. So this 0.5% rise in rates is the largest since 2000. And the last rate we had was this past March, just less than 2 months ago. And that was 25 basis points or 0.25%.
Yeah, Michelle, there was two main things that came from today's announcement. The first you just mentioned with the 50 basis point rise of interest rates. But Powell also announced that the Fed would allow the balance sheet to shrink by $47.5 billion monthly in June, July, and August. And that's $30 billion in treasuries and $17.5 billion in mortgage-backed securities. But then upping that to $95 billion monthly by September, $60 billion in treasuries, $35 billion in mortgage-backed securities. And they're going to do this, Michelle, by not reinvesting the bonds that were purchased during the lockdown. So they're just letting them roll off of the balance sheet and not renewing them. So that's how they're going to shrink our balance sheet.
So they're tightening.
Yes, that is a tightening phase, along with interest rates rising. That's a secondary. So there's why the market was so concerned going into this meeting today. So think about this. During that lockdown, though, the Federal Reserve rose our balance sheet by nearly $9 trillion by buying these government-backed bonds. Sure. They did this at that time to provide liquidity to the uncertain economy, everything that was going on, right?
Yeah, we didn't know what. Yeah, exactly, right?
No one knew. So, so since March 2020, the Federal Reserve has been providing stimulus to the economy in the form of lowering the interest rates and buying bonds. Well, now it's time to move that off the table, right? The big issue from all this stimulus, Michelle, was it's caused inflation to spike to almost unbelievable levels. We've talked about this on many of our videos. And to try and cool this economy, the Fed needs to both raise interest rates and let the bonds that were purchased expire. And the goal with this, of course, is to stop this rapid inflation from becoming permanent.
Sure. So they're trying to get supply and demand back in check, right? Back in balance. So the economy is under less stress and inflation lowers.
Yes.
All right. So do you think that they're doing enough or they're doing too much too fast? Like, will this send us into a recession, slowing the economy too fast? What are your thoughts?
Well, every one of your questions there is exactly what every different commentator was speaking about going into this meeting today. Okay. I like what happened today, and it was something that I predicted. I thought that we was rising too fast. And the language that was being portrayed was like, we're going to raise your interest rates as fast as possible.
Right. Which was the language back early in January, was it not?
It was. Yeah. Which, to your other question, would send us into a recession pretty fast. Okay. Right. But here's what happened today. The Fed did the 50 basis points as expected, but the 95 billion of runoff of securities was also expected. But guess what? They didn't do 95 billion today. They didn't do them for the month of May.
So is that why we saw the market rally? Because it looked like things were priced into the market today, but all of a sudden there's this 700-point rally.
The biggest thing that helped that 700, we're like 700
or whatever it was
right now, is because during the Fed speaking, when he was actually doing his press conference, he stated that the 75 basis points, which everyone wanted, or up to 100 basis point rise in interest rates, is off the table.
Right.
And that is, unless the economy continues on a massive high inflation status. So there is why we've seen that massive rise in the market. And it was a straight up shot after that. So,
okay. All right, let's get to the most important question. How does this affect the average person?
Okay. First, mortgage rates. Okay. Mortgage rates, they've already made the move. Okay. In the last, they went from 2 3/4 up to 5 1/4.
5%.
Yeah, over 5% in the past couple months, right? So that has already stayed ahead of what the Fed was doing here. Okay. I think that went too fast. And also what's happening right now, variable rates. So like your credit cards. Banks today are going to start, you'll probably hear them announce this afternoon, we're rising our rates on this, we're rising our rates on this, anything that has a variable rate attached to it, because this is instantaneous interest rate rises. And you will start to see that in the coming weeks on like your credit cards and loans that are variable rates.
Okay. So here's the $1 million question. I do not have it cited. I don't have it in front of me, but I was reading today, I think the Fed of New York a few months ago published something talking about the amount of debt that was taken on in 2021 in the fourth quarter, like total household debt. And so that's it. We hear, I should say, of people, draining their savings to be able to afford gasoline. And, we've got food and energy price shocks that are just every time we think, well, it can't get worse, guess what happens, right? So what's your advice to people who are strapped for cash due to just being able to put food on the table and, paying for energy? I mean, summer's coming, right?
Everything's going.
But that they also have, so people that are that, and they also have, like, for example, credit card debt. Right. With some of these variable rates, they have loans, they have whatever it is. I mean, at some point, as my mom always used to say, you can't squeeze blood out of a turnip.
That's so true. Think of it this way, though. What were we talking about 6 months ago? One of the biggest things was the savings rate. Yeah. This was the highest savings rates, Michelle, that I, in my 25-year career, have ever seen. Okay. People had money, and guess what? They still do. Okay. And they're spending it differently based on their wants and needs right now. Sure. Okay. That's one of the biggest reasons for the inflation where it's at right now. It's not just the Fed. Yeah. It's us out there spending too.
Yeah. It's a supply and demand imbalance for sure. 100%.
You're exactly right.
And then you add on to that the whole Ukraine, and you add
everything
supply
else,
chain issues and
geopolitical and
a lot of geopolitical.
But think about this: we're coming into midterms and 2 years away from the next presidential election. There are always good moves for the market. It brings hope back into these elections. So, any advice I'd give right now: just stay the course with what you're doing right now. And in all honesty, look. The Fed to me today was pretty dovish. And because all morning long, all this past week, they were talking about $95 billion in runoff of mortgage-backed securities and the treasuries, right? That didn't happen today. What happened today was half that amount starting next month. So June, July, and August. And then finally in September, we may go up to the 95 billion. Well, that is pretty dovish because that is less than what was predicted. To me, I thought the market would have rallied faster. Yeah, we're well over 700 points to the upside right now. So pretty exciting. I think it was just overdone. And in the market always overcorrects. And guess what? Now it's coming back. Sure. And the Fed overcorrected both ways. Should they have started raising rates a year ago? Very good possibility they should have. We had huge signs of inflation last year, right? But we didn't start raising rates till March of this year. So
right. All right. Well, there you have it. Thank you, Brian. Appreciate it. If you like the content of this video, hit that like button. Help us grow this channel. Also subscribe so you don't miss another video from us. And thank you again, Brian. And thanks to everybody who is watching or who watched.
Thanks, everyone.
Have a good one.